The economic downturn that began in the United States quickly spread to Europe. By 1929, many European nations were experiencing a respectable economic recovery, but much of that recovery had been financed by American investment capital. At the time, the United States was one of the few countries with sufficient wealth to invest abroad. When the American stock market collapsed, banks and businesses desperately sought liquid assets to meet their financial obligations. One of the fastest ways to raise cash was to sell investments held in Europe and bring that money back to the United States. This sudden withdrawal of American capital effectively pulled the rug out from under the European economy. The results in Europe closely mirrored those in the United States. As businesses faced declining revenues, they could no longer afford to keep all of their employees and began laying workers off. Unemployed workers had less money to spend, causing consumer demand to fall. As demand decreased, businesses received fewer orders for their products, which led to further layoffs and an even deeper economic decline. This cycle became self-reinforcing. As more companies reduced their workforce, more people lost their jobs and stopped spending. Government tax revenues declined as economic activity slowed, forcing governments to cut their own budgets and lay off public employees, including civil servants, maintenance workers, school teachers, and college professors. These newly unemployed workers also reduced their spending, further weakening the economy. The Great Depression therefore created a snowball effect. As economic conditions worsened, the downturn accelerated and spread throughout society. In 1930, the first full year of the Depression, unemployment rates were United States, 7.8%, Britain, 14.6%, Germany, 15.3%, Netherlands, 9.7%. By 1932, unemployment had reached some of its highest levels. United States, 25%, Britain, 22.5%, Germany, 30.1%, Netherlands, 29.5%. Germany's unemployment rate began to decline after 1933. The rise of Adolf Hitler and the Nazi regime brought extensive government programs aimed at reducing unemployment through public works projects, military expansion, and increased state spending. The German unemployment rate fell from approximately 30% in 1932 to 26% in 1933, and then dropped dramatically to 14.9% in 1934. It continued to decline throughout the decade, reaching 2.1% by 1938. By 1939, official unemployment had virtually disappeared. However, it is important to note that this decline was closely tied to massive government spending, rearmament, military conscription, and preparations for war. In 1939, World War II began, further increasing employment through military mobilization. By comparison, in 1939, unemployment rates remained considerably higher in other countries. United States, 16.7%, Britain, 11.7%, Netherlands, 21%. These figures illustrate the severe and prolonged impact of the Great Depression on both the American and European economies.